Happy New Year, everybody. This is Jason Ostrowski, and welcome to a 2021 edition of the Everything Real Estate Podcast. Feels a little funny to say 2021, but I know all of us out there have been kind of waiting to turn the page on 2020. And as we start out the new year, I thought that we would touch base about a topic that goes hand in hand with the real estate business, and that is the mortgage side of things. And with the change that you all are aware of now from Trident moving to Prosperity, I thought it would be a good opportunity to actually talk with Chris Smith, who is the regional sales manager now with Prosperity Mortgage, formerly known as Trident Mortgage, about 2021, what the changes are going to mean for us moving to Prosperity, and what the mortgage market is going to do in general. So let's dive into the topic of mortgages for 2021 with Chris Smith, and we'll talk on the other side. Hey, Chris, how you doing today?
I'm doing awesome, Jason. Thanks so much for having me.
Yeah, I big things are afoot, obviously, with, Trident now converting to Prosperity Mortgage. And I thought this would be the perfect time to have you on to start off with that and talk a little bit about that, because I think in agents' minds, they are so used to that Trident name, right? They've known Trident for years and years and years. I remember when I started, we were Prudential Fox and Roach, right? And we had the changeover to BHHS, and before that it was PPP, and so on down the line. The real estate side has had many changes and many evolutions over time, but the Trident side has been consistent for a long time. So I wanted to start there. That why was the name change, number one, required? And how will the change to Prosperity Mortgage help our agents? Because I think that's the big question right now in agents' minds.
Yeah, so great question. So you had mentioned before kind of the iterations of Prudential Fox and Roach, and then Berkshire Hathaway Fox and Roach. And basically in 2013, when the brokerage went from Fox and Roach to Berkshire Hathaway Fox and Roach, Trident Mortgage went along with that. So we were a service provider for Home Services of America, which is Berkshire Hathaway's real estate world. So we sat in that position from 2013 until current as an affiliated lender for Fox and Roach. And around 2017, Berkshire Hathaway did the same thing with Long and Foster. And at the time, Long and Foster was utilizing Prosperity Home Mortgage for their in-house service. Long and Foster is a substantially larger organization, at least countrywide, than Fox and Roach was. And as a result, Prosperity Home Mortgage grew with that. Fast forward to 2020, the powers that be at Berkshire Hathaway Home Services thought an integration between Trident Mortgage and Prosperity would be a good idea. Up until that point, we were running parallel to each other. Prosperity was a substantially larger organization than Trident because they were nationwide. Trident Mortgage is just tri-state area. So with that, the powers that be thought, hey, merging these two companies together, integrating their services would not only help improve economies of scale, it would help improve customer services and experiences. And also from an accounting perspective, HR perspective, you name it, integrating these two companies together would just make things a lot easier.
Yeah, and I know, my lender in my office, shout out to Jake Cullen, who is the man. He's great at what he does. I know at one point in time he was with Prosperity Mortgage, and I know that, the changeover will be seamless, we hope. And I know from a product perspective, what does the direct impact have of now being under that Prosperity banner for the agents? What does that mean for them?
Yeah, I mean, this is so for sales guys in the mortgage industry, we get kind of geeked out over the fun stuff in the mortgage business, which a lot of people might roll their eyes. But technology for mortgage salespeople is what gets us up in the morning and gets us motivated. Prosperity is constantly on the cutting edge of rolling out new fun products, but also technology that makes the experience for not only the borrower, but the agents better. They I think, closed out 2020, which was a really tough year for the mortgage industry just because of the volume perspective. Prosperity closed out the year with a 97% net promoter score. And most of that is centered around their technology that really streamlines the process for the borrowers, which also trickles down to the realtor. And how does it trickle down to the realtor? Their technology cleans up mortgage commitments, right? So, back in the day, we used to see mortgage commitments that would have 10, 11, 12 conditions on it. And that was a little bit tough to hand over to agents where they would, potentially have an issue with a loan that wasn't essentially ready to go. Prosperity systems really simplify, streamline, clear up conditions right out of the gates so that when we deliver commitments to our agents, A, they're very clean, but B, it'll also help us close loans at a quicker pace. So Trident was always known for closing loans very quickly. I mean, we used to close them in one day. Rules came into place that made us close them no shorter than 2 weeks. But now with some of the new technology that we're rolling out, we should be back on pace for very quick closings, very clean commitments.
Which is huge in this market. I mean, that's really the name of the game, right? People prefer cash offers because, if you're getting title on a property, you could settle within a couple of weeks, if not 10 days. Now with a mortgage, usually we want to allow that 30-day window. And I'm sure that, you would still like to have that 30 days, but in a pinch, maybe we could do a little bit faster. Is that safe to say?
Yeah, I would say most of your good mortgage companies, especially your local lenders, can close loans in 30 days. The real special ones are the ones that can knock them out in 2 weeks and it be pretty seamless. Some of the things that they offer or something that would jump out to an agent, in my opinion, would be they have the ability to pre-underwrite loans, right? So basically, instead of issuing you a pre-qual, if you want something that is as good as cash, they do have a kind of direct to underwrite pre-approval. So basically, you're getting a mortgage commitment in hand.
That's great.
They also have a really cool feature where you can lock an interest rate prior to finding a house. So right now, not a big deal. But when the market gets a little bit more volatile and there's thoughts that the interest rates are going to jump up, they have a program where you're able to lock a rate prior to finding a home. And you can hold that interest rate, I think, for up to 6 months.
Wow. That rate right there to me is, as an agent, that's music to my ears, right? Because you may have something, number one, you want to have someone lock in a rate that that is, right now it's almost like a spoil of riches right now as far as rates are concerned. In my opinion, what's the difference between 2.5 or 2 and 2.75? You know what I mean, or 2.58. But having said that, I think your point is a great one for agents to know that they can do that potentially with a client. That's huge. And from what I understand, if I'm understanding correctly, and correct me if I'm wrong, can we deal directly now with Fannie and Freddie? Is that going to have an impact on the mortgage rates themselves? Is that?
Yeah. So what happens? A couple things when you deal directly with Fannie and Freddie. Fannie and Freddie paints a very black and white set of guidelines. And those guidelines can be open to interpretations. And prior to coming to Prosperity, Trident Mortgage had to think about our investor. And our investor wasn't Fannie Mae. It would be a Wells Fargo or a Bank of America, et cetera. And with those investors comes what we call overlays. So Fannie Mae has a stacking order. You have to meet this. And then those big banks like Bank of America and Wells Fargo, they can have their overlays on top of that, which can add to your conditions and make the process a little bit more tedious. When you deal directly with Fannie, those conditions get peeled off, okay? So that, as I mentioned earlier, cleaner commitments, easier process, all right? We're only trying to satisfy Fannie Mae. We're not trying to satisfy the big banks that may purchase the loan. Also, interest rates, same story, right? If you eliminate the middleman, such as a Wells Fargo or a Chase or a Bank of America, it also helps improve your interest rates. So at the end of the day, we'll be a little bit more competitive than we were at Trident from an interest rate perspective. But the big selling point to me is quicker, cleaner loan files.
Yeah, that's awesome. And that's obviously the name of the game. So, okay. All right. Now that that's out of the way, because I think that was the most pressing and most important issue, I think, from an agent perspective. What does it mean going forward, right? What you just said right there, I think, is worth its weight in gold as to why people should use, Prosperity moving forward. So for me, you have me sold. So I guess I'm an easy target because I was always a believer in Trident anyway. But
one thing I can tell you, Jason, and I apologize for cutting you off.
Yeah, that's all right.
So Prosperity's mission, right? So when we met with Prosperity, their mission is to be the number one purchase lender in the country. All right. So being the number one lender means you have to deal with the refinances and the purchases. They want to be the number one purchase lender. And that's what Trident was in this area. We were the number one purchase lender. We focused primarily on purchase business. Refinances can be a bit of a distraction. It can gum up the works. It can slow things down. Prosperity, they're focused on real estate firms like Berkshire Hathaway, like Long and Foster. And so their specialty is getting your purchase files to the closing table as quickly and easy as possible.
Sounds good. All right. So moving on, I just wanted to touch base. Last year, obviously, we always reference COVID with all the podcasts because it's just in everybody's lives right now. And 2020 was such, a unique year. Obviously, a very scary year for many reasons, health-wise, but business-wise. You almost feel in our profession where so many struggled, a lot of agents had banner years last year. And from a mortgage perspective, with the interest rates being so low, I know that the refi business was pretty incredible last year. I know that from a mortgage perspective, everybody was busier. So moving into 2021, number one, how do you see the market shaping up? And number two, do you think it's kind of going to be, a repeat of last year? How do you find this year is going to be mortgage-wise?
Yeah, I think if you ask some of the experts, obviously, we're going to continue to see low rates. And low rates is what really drives interest, in my opinion. Our president, Tim Wilson, is betting on this year being very similar, maybe slightly less than 2020 from a production basis. I think they're thinking maybe 5 to 10% less in volume for the mortgage company, which to me is a much healthier business. Last year, we were drinking from a fire hose. And this year, we're hoping to, at least slow that down to a manageable pace. But I still think you're going to find buyers eagerly looking to purchase because interest rates, affordability, and people are sitting at home and staring at their houses and wanting more. So again, the market's going to be nice, strong. Agents are going to be busy. Mortgage companies are going to continue to be busy.
Yeah. And, we keep hearing over and over again that, and I know interest rates are due to kind of stay low. Do you anticipate that's going to be the whole year through? Do you think at some point, we've been saying this for years, that eventually rates are going to have to rise. And I know it's going to be based economically, and with COVID, you would think there wouldn't be a reason for them to raise any of the rates at this point. But, is there any reason to think that maybe the rates couldn't even go a little lower? Could you see that happening in a scenario?
Yeah, I personally don't see rates going any lower. I think a lot of banks have put their floors in from a rate perspective. And that's just to say, if they go any lower, we're going to end up what we call churning business, which is deals that we closed back in March, April, and May. We're going to find ourselves refinancing them because those interest rates were at 3%, 3.25%. If interest rates drop below their current standards, which is like 2.75, 2.625 on purchased loans, we could find ourselves going after that business that we just closed 8 to 10 months ago, and banks don't want that. When loans pay off early, banks can lose a lot of money. Going forward, seeing interest rates rise. Hey, listen, the first day that we've seen interest rates jump up was when the Capitol building had its riots. That uncertainty, that political scene, that was the first day where we saw an uptick in interest rates of about 1/8%. And we hadn't seen that type of volatility in the better part of 6 months. So just one day, something we've never seen before, political, where we are seeing protests in the nation's capital. That was enough to turn the market sour. And that's when we saw an uptick in interest rates. So forecasting that stuff can be incredibly difficult. But I think overall, the general mentality is that we will continue to see sub 3% interest rates through most of, if not all of 2021.
Yeah, that's great for our clients, obviously. With the pricing that's out there. The other thing I wanted to touch base about is just, from an appraisal standpoint, did you see a lot of appraisal issues on your end this past year?
Yes and no. I would say it was no more or no less than what we saw in previous years. What was very difficult to handle was when the appraisals did come in low. It was oftentimes emotional purchases. People have lost out on 2, 3, 4 bids. And, whether it was the husband, the wife, they were just like, we're not going to lose this one. And they went in way above, and it was just unsubstantiated. And at the end of the day, I think the buyers, when they saw the low appraisal, were like, this appraisal actually saved me money because I was going in with an emotional offer. But no more, no less than previous years. This year is going to really set the pace for next year's, at least the home values. And, hopefully going forward, we'll continue to see kind of minimal appraisal related issues.
Yeah, from an appreciation standpoint and an appraisal standpoint, you almost want to see the appreciation obviously slow down just a little bit, because that was a key issue I know for me and just my business last year. I mean, I've had on both sides. I've had appraisals that I never thought would appraise. I've had some that I thought were a shoo-in be off by 30,000. And buyers being willing to make up that gap in this market because they had the money to do it, and they missed out, to your point, on 6 or 7 other places, and they just weren't going to let it happen again. It was just crazy, So hopefully that slows down a little bit and allows the appraisals to catch back up again. So, along just the lines of being a new year, are there any new requirements or any new limits to any of the loans, from a credit score perspective, or even from, an allowance, the allowance on a jumbo loan, for instance, or an FHA loan, the amounts?
Yeah. So it's really exciting. I mean, with this rapid appreciation that we've seen, we've seen as a result of, home values going up, Fannie Mae and Freddie Mac stepping in to kind of help with home ownership. So I can remember just a few short years ago where the conforming loan limit was $417,000. Very quickly, and I would almost say unprecedented, uptick. We went to $510,000 last year. And then this year, starting January 1st, we went up to $548,250. So what's great about that is you have more homeowners fitting into your conventional financing space. They don't have to go into that jumbo mortgage market, which requires larger down payments, typically has a slightly higher interest rate. So $548,000 and under, you're fitting into a conventional mortgage, which again, very competitive interest rates, limited down payments to as little as 3% down, and very affordable mortgage insurance. So yeah, starting January 1st, great news being able to bump up that conventional conforming loan limit.
And is there any changes to any credit score requirements, FHA, VA, any of that stuff?
Yeah, so no, all your credit score requirements are still in place. We did see during the early stages of COVID, a lot of institutions pulled back on their credit score requirements. So FHA had a 580 credit score requirement pre-COVID, and you saw most institutions bump that up to a 640. A lot of institutions, as the economy settled down, dropped that FHA credit score from the 640 to a 620 mark. There are still a few institutions out there going down to a 580, but that's still a very risky proposition. But your conventional mortgages are all still going to 620. So very much back to pre-COVID guidelines, pre-COVID credit score requirements.
Okay. And that's why I asked, because I know some of the requirements changed with COVID. I wasn't sure if they had, changed back or where things stood. But that's good to know going into the new year. And, along those lines with the changeover to Prosperity and what we're going to be offering, is there a loan product out there that you think is underserved or underutilized? You had mentioned, 3% loans. I know that lender paid MI, is something that's popular. Is there something that you find that, maybe a good product for a buyer that maybe agents just don't know about, or it's kind of underserved? I mean, you on the spot there.
Yeah, no, it's a great question, and I love when I can inform agents on how to sell in situations where you have a buyer who's pretty adamant that they can't buy. So, for example, if you're showing rentals and your renter is willing to spend $1,500 a month in rent, and the question's like, why don't you consider buying? And oftentimes the answer is, well, I don't have 20% down. And that's kind of like an age-old saying, 20% down when you buy a home. But these days, there are some great low down payment programs. One of them that is offered through the state of Pennsylvania is called a PHFA loan. And what they will actually do is they'll extend up to 97% of the sales price of the home as a 30-year fixed mortgage with a very competitive interest rate. But on top of that, if your income allows for it, as well as if your credit score allows for it, they'll give you up to a $6,000 down payment assistance loan. So in some instances, up to $200,000, you can get 100% financing. They also extend seller assists and seller concessions. So you have somebody who's looking for a rental that makes a good income, that has a medium credit score. They can get into a house with very little money out of pocket, sometimes 100% financing. So at that point, they really need to figure out how to pay for their closing costs. But nonetheless, it's a serious program. We sell, I think we're in the top 3 in the state of Pennsylvania for selling these PHFA programs. And it's a great way to turn a renter into a buyer.
That's a great point. I mean, I think there's a lot of people out there that have clients in that situation, and I know from a rental perspective, I'm an investment property owner at this point, and I know what I pay mortgage wise, and I know what I'm getting rental wise, and it's not even close. Like, if you can buy, you buy, So being the expert that you are, I wanted to ask you a kind of off the cuff question. So I'm going to put you on the spot. Can you explain the aggregate adjustment in 10 words or less?
Oh man, 10 words or less. So the way I explain it is, it's an accounting adjustment to bring your escrow balance down to the state acceptable level. I think that's like 12 words.
So people can't see you right now, but you're literally counting on your fingers whether you got that or not. I think that's pretty good, I got to say, because that is the one thing on an Alta statement or what used to be the HUD sheet that I was just like, I hate explaining the aggregate adjustment. It just seems like it's picked out of the sky, and you don't understand where it came from. You just know where it's going. You know what I mean?
I'll tell you what, I hate explaining it too. And so I have a link saved just for that. So when a client says, what is an aggregate adjustment, Chris? Why is it a credit back to me? I have that link already saved as a canned response. Send it off to them so that they can read about it themselves.
Oh my God.
It is an annoyance.
I need that link, because that is.
I'll shoot it over to you.
It's one thing that makes me tongue tied. It's the aggregate adjustment. So, so last question, with the infusion of technology into the mortgage business, into the real estate business, the loan suite program, I kind of went through this. Are we keeping the loan suite program as it is with the change to Prosperity? Are things going to change in terms of, just the way that things are done? Mortgage package wise?
Yeah, so so if you're referencing the Trident Mortgage Loan Suite, the client facing website.
Yeah. Mm-hmm.
Yeah, so the good news is we're not keeping that. We're actually kind of ramping it up. Prosperity, actually, I was partially responsible, if not 100% responsible, for bringing that loan suite to the company.
Oh, okay.
I sourced it out, vetted it out with a couple colleagues, and really fell in love with that loan suite product. At that same time, Prosperity was vetting out their own client-facing software, and they went a different route. So both of them really solid, but we're going with the Prosperity version, which is an Encompass-based website, equally snazzy. Clients no longer have to upload pay stubs. Clients no longer have to, scan in bank statements or anything like that. It's a one-stop website where you can plug in your information and pull in all sorts of data without leaving it. So very tech savvy, very customer focused. It's created to make the process much easier.
I think any time that we can make a client's journey through the entire process easier is always a good thing. I always said, in terms of the mortgage stuff, this may be an inartful way to say this, but I would say outside of a full body cavity search, that's going to be the process for your loan, Yeah. So I'd always prepare people for that. And I think that getting that to be a little bit smoother and a little bit easier is going to be a good thing for 2021 and for all of us involved. So, Chris, thanks, man. It's always good to see you. It's always good to see a face I haven't seen in a while, even if it's through Zoom. And hopefully you and I will catch up in the new year in person and face to face.
Yeah, Jason,
or mask to mask, one of the two. Yeah.
Always a pleasure to see you.
That was this week's interview with Chris Smith, and I thank him for his time. And Chris really had some good information on the podcast this week. Number one, 2021, the rates will stay low, and that's great for our buyers because it will give them that much more buying power in a very competitive marketplace right now. Number two, speaking of buyers, Prosperity Home Mortgage is going to have some really unique and great opportunities for buyers to give them a competitive advantage moving into this spring market and the year ahead. Number one, Chris pointed out that you can now be pre-approved rather than just pre-qualified, and that is a huge deal to a seller that wants surety to know that the buyers are going to get approved for their loan and make it to the finish line. Another thing that he mentioned was that potentially buyers can lock an interest rate prior to going under contract and potentially have that interest rate last for up to 6 months. And that is just, that's incredible to me that we would be able to do that. That allows so much flexibility from the time that we settle on a property to, if there's a great interest rate out there right now and that maybe this is a once in a year opportunity for your clients to lock at a crazy low interest rate, they can now do that if they're looking for a home. And then the last thing I just wanted to make mention that a reminder that Chris had mentioned that the conforming loan, the 30-year conventional conforming loan, the limits on that are now $548,000. Again, you're giving your buyers a lot more buying power, not having to go into that jumbo territory if they can help it. So really good news on the mortgage front as we head into 2021. We'll be back in another couple weeks with a new topic, new guest. Again, if you want to hear something in particular, a topic that you would like to hear, please reach out to me, jason.ostrowski@foxroach.com. And we will see you back in another couple weeks with a brand new episode of the Everything Real Estate Podcast.